Hi, welcome. Every crisis gives us a chance to revisit things we think we knew and relearn new lessons, and in a sense, start afresh. And this last crisis has given me a chance to revisit some of the lessons that I think I've learned out of this. I know it's early in this crisis, but here are some of the things I would point to as lessons learned from the crisis. The first is, during the last 3 months, you, like me, probably listened to experts on CNBC, on Bloomberg, telling us what's going to happen to markets, what's going to happen to economies. And I don't know about you, but I've not been impressed. I've not been impressed by economics experts, by pandemic experts, by medical experts. I think the more scientists talk, the more I'm convinced that they don't know what they're talking about. So in the midst of all of this, of course, we're told that markets are crazy, they're irrational, and especially in the early days of this crisis, we were told that, hey, we should perhaps shut markets down. They're swinging too wildly. In fact, the biggest evidence given for markets being irrational was the fact that they seemed to be uncertain, that they swung on a day-to-day basis, as if we weren't doing the same things as individuals. So when you look at markets over this period, there are a couple of things that you need to keep in mind. In a crisis, markets become what's called a pricing game. Let me explain. There are two words, price and value, that we use interchangeably that we should not. We know what drives value. Value is driven by cash flows, growth, and risk. And the tools for estimating value tend to be intrinsic value models or discounted cash flow models. In contrast, price is driven by demand and supply. And what drives demand and supply? God only knows. It could be fundamentals, but it could also be mood, it could be momentum, it could be perception. And the reality is, when you get into a crisis, markets become entirely pricing games. That's not a good thing or a bad thing. It is what it is. In fact, you could argue that markets are always pricing games, but that crises exacerbate that tendency to price things. That said, though, price and value can diverge, and they can diverge on three different dimensions. The first is value has an upper bound and a lower bound. What I mean by that is, since value is driven by cash flows, growth, and risk, you and I can look at a company and come to different estimates of value. You might be an optimist, I might be a pessimist, but there are bounds. There's an upper bound and there's a lower bound in value. Price, on the other hand, is driven by demand and supply, mood and momentum, and perceptions. There is no upper bound. So when you look at a stock and say, is this overpriced? I really cannot answer that question. Whereas if you ask me, is it overvalued? I could try. Similarly, price doesn't have a lower bound. In fact, we used to think the lower bound was zero. But during this crisis, and I'll show you a picture, the evidence of this a little later, there have been cases where the prices drop below zero, especially with oil. The second is the pricing process is reactive. What does that mean? Investors react to the most recent information, often incremental information. News about a vaccine can drive the market up 3, 4, 5%. News that something bad has happened, even though it might be a small news item, can cause the market to drop 3, 4, or 5%. Value is proactive. In value, you not only have to think about what's going to happen tomorrow, the next week, the next month, 2020, but beyond 2020. So price is reactive, value is proactive. And finally, and this might be a disappointment for those of you who are true believers in value or value investors, there's nothing in this process that requires that price converge on value. What I mean by that is, just because you think the market is overvalued or a company is overvalued and you go and sell short on the stock, there's nothing in this process that requires the price to move to value, which means you can be right about the company being overvalued and go bankrupt being right. So price has no upper bounds and lower bounds. Price is reactive. Price may never converge on value. And as I said, during crises, markets are pricing instruments. That said, though, during this crisis, the market has behaved in a remarkably orderly way. Let me explain. In this graph, I have two US indices, the S&P 500 and the NASDAQ, starting February 14th, 2020. You're saying, what's so special about February 14th? At least in the Western markets, Europe and the US, that was the official date the crisis started. It was just before the weekend in Italy where they uncovered a couple of hundred COVID cases, and we realized that this virus was not going to stay bound by geography. So for the next 5 weeks, between February 14th and March 20th, stocks just went down and down and down. Terrible downstreams. And by March 23rd, the markets had bottomed out, at least so far during the crisis. Since March 23rd, the markets have gone in an upward movement, almost as sudden and large as the downward movement that preceded it. What happened in the middle of March? We'll come back and talk about it. But somewhere in the middle of March, markets seem to shift. And that's the nature of pricing. is on a dime, mood and momentum can shift. Now, looking across indices in different parts of the world, you can see the damage has been widespread. In fact, if you look at the third from the last column, you can see the damage between February 14th and March 20th. That's the heart of the crisis, the period when markets were in the downstream. And you can see across the world, indices were down 25, 30, even 40%. Between March 20th and May 1st, you can see the recovery that's been posted in many of these markets. Not enough to bring markets back to positive territory, but a great chunk of what's been lost has been recovered in most markets. If you look across indices, the damage still remains, but it's much smaller than it was on March 23rd. So stocks have clearly been damaged by this crisis, though today that damage looks smaller than it was 6 weeks ago. Now, as stocks have been damaged, there's been a flight to safety. Where has this shown up? As in most cases, it's shown up in U.S. Treasuries, where Treasury yields have dropped across the board, different maturities. The 3-month T-bill, the Treasury bill, which was trading at 1.58%, the yield of 1.58% on February 14th, dropped to about 0.1%. And that happened almost instantaneously. To those people who blame the Fed and say the Fed managed this, remember this happened well before the Fed even opened its mouth. Right as the crisis hit in the middle of February, you saw Treasuries drop and they've stayed down. In fact, the bulk of the drop in Treasuries happened in the first 2 weeks of this crisis, and you can see across the board rates are lower now than they were 8 weeks ago, 9 weeks ago, 10 weeks ago, before the crisis. Now that fear that comes with every crisis shows up in the price of risk. The price of risk, you say, what is that? In the bond market, it shows up as a default spread. And you can see how much default spreads have widened because of this crisis by comparing where they were on February 14th. So across the board, that's the first column. That's where they were on February 14th to April 3rd, which was the bottom of this particular market. On April 3rd of 2020, a triple B rated bond had tripled the spread as it did in February 14th. That shows you how much of an effect this crisis has had in the bond market in terms of pushing up the price of risk. Incidentally, there is an equivalent price of risk in the equity market called the equity risk premium. I know many of you subscribe to historical risk premiums. I don't. I've always believed that risk premium should be forward-looking and dynamic. And for those of you familiar with my work on implied equity risk premiums, I compute this at the start of every month. And I've been doing this since 2008, start of every year going back to the early 90s. But during crises, I actually estimate equity risk premiums by day. And during this crisis, I started on February 14th estimating the implied equity risk premium for the S&P 500. So let me trace out how that's changed. On February 14th, 2020, the date the crisis started, the implied equity risk premium for the S&P 500 was about 4.7%. That was my premium for mature markets that day. There was a day, March 23rd of 2020, when the implied equity risk premium for the US hit 7.75%, almost double. So what you see happening to the bond market, you're also seeing in the equity market. The price of risk is changing. Now, there are two commodities I've tracked through this crisis. One is oil and the other is copper. Both are economically sensitive, which means that this crisis slows the global economy down, which it almost certainly will in 2020. You should see it reflected in prices. Copper prices are down about 12%. Makes sense. The global economy is slowing down, copper prices have dropped. But take a look at oil prices. Brent crude is down more than 50% and West Texas crude more than 60%. What does it tell you? There's something else going on in the oil market that's beyond COVID and this crisis. That something else might be the fight between Russia and Saudi Arabia, or a long-term plan to bring US shale oil back down to earth. Whatever it is, there's clearly some other disturbance in the oil market affecting oil prices. Finally, I looked at gold and Bitcoin. Gold, of course, is the asset that people have gone to during crisis, and I wanted to see how well it served as a crisis asset during the crisis. It's done its job marginally well. It's up about 7%. You think that's pretty good? It is pretty good. But for those people who believe in gold, they're a bit disappointed. They expected gold to be up more because the crisis is of such large magnitude. I also track Bitcoin. Why? Because there are people who've sold Bitcoin as millennial gold, the currency that people are going to go to because they don't trust paper currencies. Well, we should see a flight to Bitcoin, right? We haven't seen that during this crisis. In fact, during this crisis, Bitcoin has behaved like very risky equity, not like a crisis asset. So the reason you're holding Bitcoin is because people will come to it because they lose faith. At least this crisis, that's not happened. Finally, I broke down individual stocks. I've collected the data at the end of every week for the last 12 weeks or so. At the end of every week, I've looked at the damage broken down by region, by sector, by industry. And I did break down how much stocks have been damaged by region going back to February 14th. So in this graph, in this table, for instance, I've broken down the regional damage. In fact, to give you a sense of how much damage was created, take a look at how much value global stocks lost between February 14th and March 20th. $26 trillion in value. 26 trillion. By the end of by the start of May, that number was down to 14 trillion. Still substantial, but it recouped almost 12 trillion. If you look across regions, the worst damaged parts of the world are emerging markets. Latin America is in fact the worst performing market. And you can see the best performing market is actually China. Ironic if you think about where the virus started, but China actually started to see damage before February 14th. So some of this just might be timing. Emerging markets have actually been damaged more than developed markets as you look across regions of the world. And that's an unfair aspect of these crises. They might start in developed markets, but they spill over into emerging markets. If you look by sector, you can see why I put faith in markets. Markets have behaved in a remarkably orderly way. The best performing sector has been healthcare. And that actually makes sense. At the heart of the storm, perhaps with a cure to the storm, the next best performing sector has been consumer staples. Toilet paper, we're buying it as if it's going out of style. The worst performing sectors have been energy, for obvious reasons. Oil prices are down, and financials. Banks live in reflected glory and reflected pain. So oil companies get into trouble and don't pay their debt. Guess who pays the price? Banks. Airlines get into trouble and need to renegotiate loans. Guess who pays the price? Banks. So you see banks as the worst performing sector. Looking at individual industries and the best performing and the worst performing industries, you can see that markets are behaving in a remarkably orderly way. The best performing industries tend to be tech companies, online companies, companies with low capital intensity. The worst performing businesses have been capital intensive businesses. Why? Because they're locked in, they have high fixed costs, and to add pain to this process, they often borrow money. So if you look across industries and sectors, what markets are doing is discerning. They're not knocking down the price of everything. They're knocking down the prices of those companies that they think will be worst affected by this crisis. And that's why I said at the start of this process that, when people talk about markets being chaotic and not trusting them, I trust markets more than experts. In fact, if your problem with markets are volatile, let's face it, we're all uncertain. Markets reflect their uncertainty, but there's order in the chaos as you look at what the individual companies that are being damaged and hurt the most during this crisis are doing. Now, to those people who argue that markets should be shut down, I'm thankful that nobody followed your advice. Liquidity has been a salve. It's not added to the fire. It's actually allowed us to deal with the crisis in a much healthier way. Second, as you go through this crisis, there are people around you saying, I told you so. And many of these people have agendas, which they use the crisis, which you should do this, you should do that. So I've learned through hard experience that many of these people make up stuff as they talk about their agendas. So I've learned that while I can listen to people, I should always verify. So I'll take two stories I heard early in this crisis, and I don't hear them as much anymore, and thank God for that. The first was that this crisis was a punishment for overreaching in the last decade. And that investors had become shallow and lazy. They were buying momentum stocks. They were not looking at things like cash flows and dividends. They were not reading Ben Graham's security analysis. They were not behaving the way Warren Buffett and Charlie Munger said we should. They said, you're going to get punished, and this is the punishment. So that's the first argument, that maybe this is punishment for overreach in the past. I'm going to look at the evidence to see if that is the case. The second is that this is a punishment especially for companies which have been buying back stock. The reason that story never made sense in the first place is if this had been isolated to just US companies, maybe you can point to buybacks. But to the extent that this is a global phenomenon, how can you point to buybacks? But again, I want to come back and deal seriously with the question of Has this crisis been worsened by companies buying back stock, especially in the US over the last decade or so? Let's start with the first argument, that this is in fact a punishment for growth investing getting out of hand. Let's set the table. If you look at value versus growth, and I'm going to use a very simplistic distinction of value versus growth, low price to book stocks versus high price to book stocks. I know it's shallow, but hang in there with me. If you look at the history of low price to book and high price to book stocks and look at the difference in returns, through much of the last century, low price to book stocks have earned a premium over high price to book stocks. That's the difference you see in the fourth column. But then you get to the last decade and growth stocks. I think there's one period, 1990 through 99, where the dot-com boom created this reversal. But between 2010 and 2019, you really saw a reversal. Growth stocks dominated this decade. And of course, the most visible symbol of these growth stocks were the FANG stocks: Facebook, Alphabet, Apple, Netflix. And so basically, those stocks accounted for 20% increase in the S&P 500 during this period. So you're saying, okay. No, so maybe, and during this period, what have value investors told us? Just wait for a crisis and you're going to see value return. Okay, so that was the story they were telling early in the crisis of, they wagged their fingers and said, hey, you guys who are growth investors, this is your punishment. Now, one of the advantages of having the data at our fingertips is we can look to see whether these arguments are true. So here's what I did. I took all companies around the world, broke them down by PE ratios from lowest to highest. You're saying, what is that going to tell us? If those value investors are right, the stocks that should have been damaged the most during this crisis should have been the highest PE stocks, right? Not the lowest PE. But if you look at the last column and look at the returns, it's the lowest PE stocks that have done terribly during this crisis, not the highest PE stocks. I then looked at momentum. Maybe high momentum stocks are the ones feeling the pain. No, that's not the case. The stocks that are being punished perversely are the stocks that have done the worst leading into the crisis, not the ones that have done the best. So if your argument for value versus growth is this crisis is going to bring us back to value, that's not the case. In fact, if I listened to old-time value investors and bought low PE, high dividend yield stocks, I'd have felt far more pain than buying high PE, high momentum stocks. Now, this is my view, so take it for what it's worth. I think value investing has become incredibly lazy. In fact, I use 3 R words. It's become very ritualistic. You worship at the altar of Buffett and Munger. You pay lip service to Ben Graham. It's very righteous. There's a lot of finger wagging and very rigid. All these rules that I don't even know where they come from. So I think value investing deservedly has been brought back to down to earth. And this crisis is not going to make value investing look better. It's going to make it look worse. Is there hope? Yes. If you truly are a value investor, I want you to start thinking about value much more flexibly. And maybe what this crisis will bring home is it's time to let go of Ben Graham's security analysis and start to think about value in a much more expansive way. Don't get me wrong. I believe Ben Graham was well ahead of the rest of the market in his day, and that book, Security Analysis, laid the foundations for much of what we do in intrinsic value. It's time to let go. It's time to move on. Let's look at the Buyback Bogeyman. Let me set up the story again. US companies increasingly have shifted away from dividends to buybacks over the last 30, 40 years. In fact, this graph goes back to the late 80s. And you can see the rise of buybacks in this black line, which is the percentage of the cash returned collectively by US companies in the form of buybacks. In 2019, US companies returned about 60% plus of the cash that they were returning to stockholders in the form of buybacks. Dividends have become much less common at US companies, and people are upset. Who are these people? Some of these people are old-time value investors who built their entire investing strategies around big dividends. You're not finding those companies as easily anymore. The others are economists who really don't even know what a business is, who argue that these buybacks are bad because that money could have been invested back in the business, as if that could have solved the problem. In fact, many of these companies that buy back stock have bad businesses. The last thing you want to do is have these companies reinvest more. But when this crisis hit, people said, I told you so. Especially when Boeing and the airlines got into trouble early in the crisis, they said, if only these companies hadn't been buying back stock, they wouldn't be in trouble. That is actually true with the airlines and Boeing. But I'm going to argue it's not the buybacks per se that created this problem. It was something they used to fund the buybacks. To kind of back into this, let me do something very simple. Here's what I did. I took all companies globally and I broke them down into companies that bought back stock in 2019 versus those that did not. Let's focus on the US, which is where the bulk of the buybacks still were happening in 2019, though it's spreading around the world now. In the US in 2019, it was about 50-50. Half of all companies bought back stock and half did not. It is true that the companies that bought back stock had mildly higher negative returns over this crisis. It's about 26% versus 23%. Now you say, I told you so. But if you look at what caused, but it's not just buybacks. It turns out that the same kind of effect is showing up when you look at dividend paying stocks. Both dividend paying and buyback stocks have been hurt more than non-dividend paying, non-buyback stocks. So I started digging. Why is that happening? And here's the real culprit. It's not buybacks per se that are the problem. It's how much debt these companies have. In fact, independent of the buyback issue, if you control for debt, the buyback effect disappears. It's companies that have high debt loads, and I measure debt load by looking at net debt, debt minus cash, as a multiple of EBITDA. Companies that have lots of debt relative to EBITDA have been hurt more during this crisis than companies with little debt. The lesson I take out of this crisis is not don't do buybacks. In fact, I would argue that dividends are more likely to get you into trouble in this crisis because you have to keep paying them, even though times have turned bad. It's borrowing more money than you can afford to, and doing buybacks with those is a terrible idea. So if you have a problem with Boeing and the airlines, it should be that they borrowed money they shouldn't have been borrowing. The companies were already over-levered in 2019 before the crisis, and the crisis just pushed them off the edge. Lesson 3. You've heard of the legend of smart money, right? Smart money knows when to get into markets, knows when to get out of markets, knows which stocks to buy, which stocks to sell. And smart money has names like Warren Buffett and Charlie Munger, Ray Dalio, Bill Ackman. Stupid investors are often late to the party. They buy the wrong stocks. And then people jump, okay, hedge funds are run by smart investors and retail investors are stupid investors. For whatever reason, that's the kind of stereotyping you see there. I've never believed that there's such a thing as smart money. I've looked for it for 3 decades plus now. I've never found it. And in fact, to back it up, let me give you a contrast that I've been looking at for a long time between active and passive investing. Active investing, of course, is you try to time markets, you try to pick stocks, and mutual funds, hedge funds are active investors. Passive investing takes the form of ETFs, index funds. And for the last decade, it's been a game that passive investing has been winning hands down. In what sense? Well, money's been flowing into passive investing vehicles, ETFs and index funds, and flowing out of active investors, mutual funds and hedge funds. See, the green columns are money flowing into passive vehicles, and the red columns, the money flowing out. And you can see the market share of passive investing vehicles has increased over the last decade, and it's not made active investors happy. In fact, they've had an excuse. For the last decade, their argument has been, this is a strange market, a crazy market, just wait for a crisis. And then you're going to see why you need us being active investors. Well, they have their chance now. It's still early in the crisis, but I took a look at how mutual funds did in the first quarter of 2020. Remember, almost all of the damage in this crisis happened in the first quarter of 2020. So the mutual funds are run by smart money. They should have done a little less worse than the rest of us. I don't expect them to make money, but they should have got out of stocks before the rest of us did and pick the right stocks to buy, right? This is from Morningstar. They broke in mutual funds into 9 classes. In 7 of the 9 classes, the index, and you could buy an ETF to replicate this index, would have done better than the active mutual funds. In fact, collectively across all mutual funds, active mutual funds, these are run by the smart investors, delivered 1.37% less than you could have made investing in an index fund. If this crisis was supposed to show up how good active investors were, it's clearly not worked. So I'm going to draw a different divide. It's not about smart money versus stupid money. It's about humble money versus arrogant money. And what's the difference? Humble investors recognize that success when it comes is often more due to luck than skill. And that when they fail, they've got to learn the lessons and adjust and adapt the way they pick stocks. Arrogant money thinks it's right, doubles down on mistakes and thinks the market is wrong. What I've learned through hard experience is I'd rather have my money invested by humble investors than arrogant investors. And this crisis has brought home the price of arrogance. People had concentrated portfolios who kept telling us when to get in and out of markets and got it all wrong. I know there's anecdotal evidence that some smart investors made money like Bill Ackman, but I'm not sure that that was smarts or luck. I mean, luck, because Bill Ackman has made a bunch of his own mistakes over the last few years. So if nothing else, if you're believing somehow that smart money would have got you through this crisis without damage, think again. Lesson 4. Every time you get into a crisis, you're told the fundamentals no longer matter because you're in a crisis. Well, let me remind you that the fundamentals matter more than ever before in the midst of a crisis. Let me explain. I've been computing implied equity risk premiums and value indices now for almost 3 decades. And the value of an index, let's say the S&P 500 index or stocks collectively, is a simple equation. It's the present value, the expected cash flows you get from holding those stocks, discounted back at a rate of return you would demand for investing in those stocks. Well, if you think about dividends and buybacks as the cash flows you get from holding stocks, and you put a growth on those cash flows, and you think about your required return as a function of your risk-free rate plus an equity risk premium, you can value the entire index. As I said, I've been doing that for 3 decades. And then, of course, you get into a crisis and people freak out. They say, hey, the fundamentals don't matter. So when this happened in the middle of March and people were at their absolute worst freaking out, I said, I'm going to go back to the fundamentals. And I'm going to see how those fundamentals will change because of this crisis. See these 4 boxes I've added? Those are the questions I added as a result of the crisis. The first question I asked was, hey, how will this crisis play out in earnings? Well, let's be real. 2020 earnings are going to be demolished. They're going to be terrible. But there's a follow-up question I need to answer. How will earnings recover post-2020? So the first question you've got to ask and answer is, how will earnings be affected in the near term and in the long term? Second, how will this crisis affect how much cash companies are willing to return to stockholders? Remember, the amount of cash companies are willing to return to stockholders is often a function of trust. Trust that, that they can keep their earnings stable. So when you have a crisis, often that trust goes away, so the cash they return drops off. So we know they're going to return less cash, especially in the form of buybacks. I have to kind of make my best estimate. Third question I've got to ask and answer is, how much will the risk premium change? After all, people are scared the risk premium should go up. And the risk-free rate is going to change as a result of the crisis as well. If I can ask and answer those 4 questions, I can value the index. And I did try. On March 13th of 2020, towards the very bottom of this crisis, I took the 4 big numbers. The first is, how much will 2020 earnings be affected? And I put in a base year number, base estimate. How much of that will be recovered by 2025? And I put in a base estimate. How much will equity risk premiums be? And I put in a base estimate. And finally, how much cash will be returned? I put in a base estimate. But I know I'm going to be wrong in every one of them. So here's what I did to bring in my uncertainty. I made it real. I told you this is how wrong I can be in the form of a distribution for each of these inputs. And then I ran what's called a Monte Carlo simulation. It's an incredibly powerful tool. What it does, it basically takes one outcome of each of those distributions, values the index, and does it over and over again. You see my distribution of values for the S&P 500. Remarkably symmetric. I was surprised. The median value I got at the middle of March was about 2,751. On that day, the index was trading at 2,400. And people said, could you explain that? Yeah, there's 2,400 is within the realm of possibility, but it's toward the 10th percentile. Today, the index is close to 3,000. Is that possible? Yes, but it's toward the upper end. I am actually revaluing the index now because I've learned a few things in the last 6 weeks. I have more certainty about some of these numbers, and I'm going to revalue the index. My point is, don't let people tell you the market is crazy. You cannot explain what's going on. In a world where there's this much uncertainty, there's a pretty big range on value. And I think a distribution can let you see that range. Finally, I'm a great believer that valuations have lost their way, that people have become Excel spreadsheet ninjas. They plug numbers into Excel spreadsheets. They let the modeling take over. A good valuation is a bridge between stories and numbers. And I've always believed that, and a crisis like that, this reinforces that belief. In fact, when I'm asked to value a company, I go through a 5-step process. I first start by developing a story for the company. That story is based on what I know about the company, its competition, what's happening in the economy. Second, I test the story to make sure I haven't told you a fairy tale. Is it possible? Is it plausible? Is it probable? Then I convert the story into drivers of value. You're saying, what are you talking about? My valuations tend to be very straightforward and simple. There are 3 or 4 drivers of value. I'll show you those drivers on the next page. But my job is to convert my story into those drivers. Then those drivers give me a valuation. The valuation kind of does itself once I have the drivers of value. And then I have to keep the feedback loop open. What does that mean? When I finish a valuation, I should show it to people who think least like me. Why? Because I want to hear differing points of view, things where they disagree with me. How does that help me? It helps me refine my story, tell a better story. That is the process by which I value any company. That's how I used to do it in last year. As you know, in fact, if you think about the drivers of value, ultimately all of my valuations for non-financial service companies are driven by the following inputs. There's my growth driver, revenue growth, because revenue is the cleanest measure of growth. My profitability lever shows up as an operating margin. My reinvestment lever shows up in how much I need to reinvest to get the growth. My risk lever, that shows up both as a risk premium in my cost of equity and a default spread in my cost of debt. And I bring in explicitly a failure risk issue. The reason for this is very simple. A traditional discounted cash flow valuation values a going concern. You're saying, what does that mean? In traditional discounted cash flow valuation, every company value you assume will survive and make it. That's why you have that big terminal value. But the problem you have in a crisis is there's a chance your company will not make it. And there's nothing you can do in a DCF to bring that in. Don't try to adjust discount rates. It will not work. So what I do is I bring in an explicit failure risk, where I said there is a 15-20% chance my company will not make it, and try to incorporate that into value. So let me close with a couple of valuations. One was a valuation I did of Tesla pre-crisis. To illustrate the storytelling part, I told a story of Tesla. It's a big story of it being an automobile company with a tech component where software is going to be part of their revenues that allows them to earn higher margins and reinvest more efficiently than the typical automobile company. To give you a sense of the scale of the story, I'm projecting revenues of $128 billion for Tesla. That's going from about $30 billion, which will make Tesla bigger than BMW by the time you get to 2029. Do I think it's plausible? Yes, I do. It's a big story, but it's a plausible story. And at least in my story, the value that I get for Tesla is about $428 per share. This is a valuation I did in February, pre-crisis. The stock was trading at $640. I actually sold Tesla. I bought Tesla a year ago when it was at $180. I sold it based on my story and my valuation. My point is, pre-crisis, I was valuing companies with a story, converting that story into inputs and those inputs into value. You think that should have all have changed, right, in the crisis? Why? We know the crisis affects companies. How much? It depends on the company. If you're a company that produces discretionary products, luxury products, you're more affected than you're a company that produces food. If you're a company that's people intensive, a theme park, you're affected more than if you're a company that can run based upon a few people, a power utility. If you're a company with high fixed costs, you're affected more than if you're a company with low fixed costs. In fact, staying on the notion of fixed costs, the more financial leverage you are, you're more affected by this crisis than if you're less levered. And finally, if you're a company that is burning through cash, but why? Because you're a young, growing company, you're more exposed to this crisis than if you're a cash positive company. And finally, if you're travel related, this crisis has been deadly for you. So this is a picture I drew early in the crisis. So my point is, when you value a company, the crisis is it. You can't be in denial and act like it hasn't happened. You got to ask yourself, how will my company be affected by the crisis? And more importantly, what will it look like coming out of the crisis? Because in a crisis, the dark side will beckon. What does that mean? In a crisis, people will tell you that you can't value companies, that it's too difficult to do, there's too much uncertainty. That's absurd. It's precisely when you feel uncertain that you should try to value companies. It's precisely when you want to give up that you want to stay in there and try to stay with fundamentals. So I've taken the framework I have that I showed you and adapted it to the crisis. In fact, I'll put up a link to the YouTube video that I created because I created a spreadsheet that allows me to bring in the virus explicitly into my valuation. And it's not fancy. Here's what I do. I separate 2020 from the rest of time. Why? Because 2020 is going to be a strange year. It's going to be an abysmal year for most of your companies. And if I get mired in 2020, then I'm never going to finish my valuation. So when you value a company, you got to ask the short-term question, what will this crisis do to my company in the near term? But then you got to ask a bigger question. What will my company look like in the post-viral world? And along the way, you got to adjust for the fact that the prices of risk have changed because you're in a crisis, and there might be a much higher chance your company might not make it because of the crisis. So I'm going to give you a close with two companies I valued as one right as the crisis got started that I'm going to revalue again in a couple of weeks and get a very different value, and one that I valued right at the heat of the crisis, in the middle of March. The first company I'm going to value is Zoom, a company that's clearly been in the news, has quite a lot of publicity, a lot of new customers during the crisis. And this was a valuation I did early in March. Just to give you some background, Zoom, of course, is an online software company. It makes its money, at least its original intent was to make money on online business meetings. I actually was lucky enough to value Zoom in January 2020, before the crisis. And at that time, when I looked up the size of the online business meeting market, the total market globally was about 19 billion. So in my story, I made Zoom a successful company. I liked Zoom even in January 2020, before the crisis. I assumed they would capture about 40 to 50% of this online business market because I saw them leaving WebEx and Team in the dust when it came to those markets. I gave them about half of the online business market, revenues of about 8 billion. This was January 2020, and valued them at about $30 per share. Now the crisis hit. This was early in the crisis. I could see that people were starting to use Zoom, a lot more people. Now there are two things I think that are going to happen because of this crisis. One is in the near term in 2020, Zoom is not going to benefit that much because it's giving away its product offering for free. But because people use Zoom in this crisis, it might change the way they behave in the future, which makes that potential market much bigger coming out of the crisis. I firmly believe that after this crisis, there'll be more online business meetings. Why? Because people realize it's not that complicated and not that difficult. So maybe the online business market, instead of being 19 billion, will be 40 billion. You're saying, how do you know? Well, I've got to make my best estimates. So this was early in the crisis. I valued Zoom with a much bigger market. So I gave them bigger revenues, 11.4 billion. My story is expanded. Much higher margins, software company margins, and came up with a value of about $50 per share. The stock was trading at 115. Now, I think I need to revisit this valuation because as I've seen Zoom make its inroads into education, it's entirely possible that the future market for Zoom might not just be online business, but online education. Could that make my story bigger? Yes. Will that explain away the price? No, I don't think so. I think Zoom is still overvalued, but not by as much as you think, because the story itself is shifting. So Zoom is a good story coming out of the crisis. Here's a potentially bad story. Early in this crisis, there was worry about Boeing and the airlines, especially with Boeing going under. And Boeing made it through. In fact, I think one of the things that triggered the turnaround of this crisis was in the middle of March, Boeing was able to borrow money in the private markets. They didn't have to wait for the Fed to bail it out. So right in the middle of March, I valued Boeing and I told a story. It's not an upbeat story because it's tough to tell an upbeat story about Boeing in the middle of this crisis. So I saw revenues dropping 10% in 2020. You might say, only 10%? Boeing's revenues in 2019, the most recent year, were already down 30% over 2018 because of the 737 MAX. In fact, they were expecting revenues to bounce back to close to 100 billion in 2020. I don't think that's going to happen. I think revenues are going to continue to drop. They will continue to lose a lot of money, but I think they will come back. Why? Because in my story, there are only two companies from which you can buy big aircraft, Boeing and Airbus. So they're not going to go away. There's going to be no new company coming out of this mix. So I think they will survive. There's a chance they will not. I'll come and talk about it in the last part of the valuation. I will assume they will survive. They will make it back to health and reasonable margins. And with that story, the value I would get for Boeing would be about $165 or $170 per share. But here's what I'm missing in a DCF. I'm assuming in that DCF that they will make it back to health. But Boeing in the middle of March was still close enough to the edge that one more shock to the system could have tipped them over. In what sense? I don't think Boeing would go under. They're too big to fail. But they might have been bailed out by the federal government in such a way that the equity got wiped out. That's what happened to GM in 2009. In the middle of March 2019, I estimated a 20% chance, which is a pretty big, large probability for a big company like Boeing, that they would not make it, that my equity would be worth nothing. That expected value that I get with that 20% failure risk built in was $147 per share. The stock was trading at 128. I'm going back to basics. I'm going back to the fundamentals. I'm going back to the things I'm comfortable with, because in a crisis, the first casualty is perspective. The second casualty is fundamentals. I've learned in crisis that I need to hug the fundamentals. I need to adapt them. But don't be mechanistic. Don't take your old DCF models and just plug numbers in. They will not work. You have to be creative and you have to be flexible. I hope you found the session to be useful. And if you have any questions, you know how to find me. Thank you very much for listening.